A disappointing day for Indian markets. Nifty has cracked and closed convincingly below 6,000. So what led to today's decline? Short covering or absolute profit booking? We'll discuss that and much more for you on this edition of Markets Tomorrow with the help of Varun Lochamp. He's Managing Director and co-head with Religare Capital Markets. Sandeep Wagle, Managing Director and Founder and Managing Director, Apitar Technical Advisory, and then Neeraj Diwan, Director of Quantum Security. We also will join us live from New Delhi. Sandeep Wagle, we have gone below 6,000.
Yes, Nikunj, I won't read too much into that. Though we have gone below 6,000, I still maintain that 5950 is a very strong support area for me. Until that is taken out, I don't want to believe that we will crack down one way as far as the Nifty is concerned. On the other hand, stock-specific moves are already happening. So we don't need the Nifty to crack down one way for that. The Nifty will probably find support at 5950, 5940, 10, 20 points here or there. And in case that doesn't happen, mind you, then we have to talk of probably 5700, and even that can be tested. I'm willing to believe that I would go short on the Nifty, but not as of now. You will have stock specific moves. Yes, the sentiment is a little down. More stocks with high beta are falling, and that is coming in the II. That is what I would say. Not to say that I am very bullish or so. Individually, if you go by the stocks available, you are getting more sell calls than buy calls in the current scenario. So some more downside to the tune of 30-40 points on the Nifty. Individual stocks is a different story.
Neeraj, what is your assessment? Do you think foundation of the market rally now are looking slightly shaky?
Yeah, good evening, Nikunj. I don't think it is the case right now. I think in the last 2 weeks, if you see, I think market had corrected. Market index-wise may not have corrected, but stock-wise, you've seen stocks correcting 10 to 15%. I think it's a healthy correction which has happened in the market after a dream run that we saw. And I think post such correction, I feel that I'm even looking at a pre-budget rally which can start anytime now. So I would be stock-specific buying, and I think it's a good opportunity for people who missed out on the other rally to again come back into the market stock-specific. Even it's a good timing-wise. We've seen the results also, so we know where to put your money in now, where the results have been decent, and there's been some stability as far as earnings is concerned.
Neeraj, but do you think the demand-supply equation for Indian markets has changed? Yes, the news flow is still positive and constructive. Earnings are accelerating. A rate cut has kicked in, but it's the fresh paper. It's the appetite by corporate India which really could disturb the setup, the liquidity setup.
Yeah, see, there has been, because of even our domestic institutions have been selling because of all these issues which are coming. I think one more is lined up, so that can definitely suck in some money, which is already done. You've seen our top institution, Indian institution, insurance company has also been selling. So I think going ahead, I think there's one more positive there, that after the NTPC issue, I think at least, if not buying, at least that selling can stop. So FIs have been buying, and if you have that selling also stopping, that can have a positive impact as far as flows are concerned. So I will be betting on that, and I think that can be a positive sign for the markets.
Varun, let me encourage you to also join in here. Auto dispatch numbers which have come out in the last 2 days, they are not encouraging. In fact, they are pointing to a visible slowdown. But auto stocks today, they held on very nicely. What's happening there, and why are auto stocks still holding on?
See, I think auto numbers were frankly not great, but at the same time the expectations were also not very high. So if you see Maruti, I think they have, despite a low growth on a YOY basis, it's still marginally ahead of what we were expecting. M&M numbers are good. So I think net two-wheelers were expected to be weak. Hero Moto was slightly weak, but Bajaj Auto was okay. So I think the expectations are also low from the volume growth perspective, and on that the auto stocks have not disappointed, frankly. So we continue to be overweight on auto sector. Overall our top picks in the space are M&M, Tata Motors and Bajaj Auto.
Sandeep Wagle, the other big story today was banks. PSU banks, they took it on the chin. They corrected on strong volumes. State Bank of India, Punjab National Bank, Union Bank, Allahabad Bank, Dena Bank. It's a long list. I don't want to talk about the entire list, but the bottom line here is PSU banks are coming under pressure.
Well, yes, specifically I would want to mention the Bank of Baroda. I mean, the way it has cracked 7-8% fall on a day. Obviously, the markets have not liked what it has offered in the form of the results. And having said that, I think we have missed out. I mean, you can't go short now. Maybe on a little bit of an up move, yes. But at higher levels, they were facing stiff resistance. And what we have seen will probably continue for a day or two. But I'll still be comfortable selling some of the banks at a little higher level on a bounce back.
Neeraj, what is the deal with PSU banks? Even though optically they look attractive, bond yields are looking stable. Why are PSU banks underperforming?
Actually, if you see, results have been pretty volatile. You know, lot of the PSU banks have not come out again with good set of results. But I think that said and done, you know, if you compare today's Bank of Baroda with the PNB numbers last quarter, the numbers there were really bad. And the PNB, after hitting a low, after seeing a sell-off, has bounced back sharply, and this quarter numbers were better. So I think banks are also going through this phase where they are making provisions for a lot of the bad assets, and they're also trying to align themselves to the markets. I think that is what is happening, and I feel maybe this or the next quarter these things can bottom. I think the NPA cycle and the provisioning can bottom, and then you can, you know, after interest rates are coming down, you can even see a recovery cycle coming back into the banks. So PSU banks, definitely they are quite volatile. They are like today also they sold off. So, but valuation wise, I think you need to pick up banks where you feel that major of the pain is already over. So I think you have to spend this time, maybe the next couple of months, picking up those banks and which can give you decent returns from the next quarter onwards.
Okay, the good bit in today's market activity was PFC and REC. Power finance companies, they were on a tear. REC numbers came out, numbers were impressive. The only reason why PFC and REC are outperforming in the near term is because the demand for demand for some of these financiers is making a comeback. Because most of the state electricity boards now have a better balance sheet. Most of the analysts are of the view that the next financial year, which is FY14, will be a better year for REC and PFC. Sandeep Agle, purely on the charts, PFC and REC.
Yes, Nikunj, I agree with you. I would choose REC between the two. We had an intraday buy and we have carried forward that also, and I expect another 4-5% upside even from the closing level. So a very clear buy even in this kind of a market scenario. So a little bit of a decline, 0.5%, 1%, one gets a chance. I think REC, that is a buy for me today, and I would buy it with a target of around 256 or so.
Neeraj, is one better off buying PFC and REC in the near term instead of buying PSU banks?
Yeah, I think so, and even I've been recommending PFC and REC for the last couple of months now. They both are under our coverage, and you know, even after giving a very conservative valuation of 1.35 times books to PFC and 1.5 times to REC, being little better returns in REC, we still get a decent upside of 20-25% even from the current level for the next 12 months. So I think they would have, like, even in stability wise, if you see the earnings, there have been more stable, the NIMs have been maintained, and even where people had so much concern about NPS, there also we've not seen any new account going into NPS. And now, like you rightly mentioned about the State Electricity Board, they're also condition improving by increasing tariffs going ahead, and government is also very clear that they don't want state to pass on the burden to the center. So all these things happening, and plus reforms in the power sector, which we've been talking about for so long now, things need to come on board regarding that also. So I think PFC and REC can be a good performer even for the next 12 months.
Varun, this question is coming your way. The group I want to discuss with you is the entire oil and gas space. Now, the street clearly is divided on how to approach the entire OMC stroke oil and gas space.
Yeah, I think oil and gas, we are not, I would say, overly bullish, but I think all the steps being taken by the government definitely puts us in a better shape. So if you see, oil and gas sector has been clearly underperforming the markets for several years, and when such a sector also starts supporting the market, you have all the more reason that market can remain well supported. So within oil and gas, we are not significantly overweight the sector, but we like ONGC and we also like BPCL, HPCL.
What about exploration companies?
See, consumers we are underweight, pharma we are underweight, utilities and telecom. These are four sectors where we are underweight.
You also have a underweight call on pharmaceuticals, Varun. Why is that?
See, we are frankly not too negative on pharma. If you pick between consumers and pharma, I think consumers is where we are more worried because of valuation. But pharma again, we believe valuations are quite fair, and therefore you may not see a big leg up in the stocks. They have also been beneficiaries in last 12 months of depreciating currency, which doesn't look to be the case right now. Rupee again seems to have stabilized in a band. So I think pharma, you could still have stocks returning 10-15% easily in a year, but they will not be big outperformers in this market, we believe.
Neeraj, at the current juncture, how are you picking your spots? What are you telling your clients?
I think sector specific, if you go, I think oil and gas is one sector which is interesting, and we are looking at opportunities in oil and gas sector. Then even IT, I think the kind of guidance which came from the large cap IT names, I think the next year looks encouraging for IT also. And then we come down to financials. I think these are the three sectors in this order which we are quite bullish on for the next 1 year. And we are looking at opportunities in these sectors, like in IT also. Large cap stocks, it's very difficult to put in money now and make a very good return for the next 1 year. But there are mid cap IT stocks which have like decent managements which can give a good return. So I think we are picking stocks in these three sectors which can give a good return for the next 1 year.
Give me an example, Neeraj, which captures your thoughts.
Like for IT, I mentioned, IT. If we go through our mid cap coverage in IT, NIT Technologies is one of them which came out with a decent set of results. It's in our buy list, and I think even from the current level, it can give a 30-35% return over the next 12 to 18 months. So these are the kind of stocks we're looking at, where the managements are good, the growth has been good, they've added good number of clients, good accounts in the last couple of years, and they're going to pay in the next 1 year. So these are the kind of stocks we're looking at.
Sandeep Agle, what is the deal with JP Associates? For the year gone by, JP Associates was up 77%. But this year, even the markets are still holding on. JP Associates has corrected by about 15% from the recent high. It's rather irritating to trade in and out of that stock, and it's rather embarrassing to own that stock now, even if you're a long-term investor.
Nikunj, I think you have hit the nail on the head. At a level of 95, it lost all its momentum when it broke down after going to 106 when it broke down 95 on the downside. That is where we had recommended a sell in the stock or exiting that stock. And at the current level of 80, 78, I still see some more downside, and that downside could be to the tune of 68 to 70. So I would talk of easily a 10 to 15 to maybe 18% downside and a very clear sell on a little bit of an up move. I don't see the stock go beyond 85. I think it will touch 68 to 70 before that.
Neeraj, what are your thoughts on JP Associates, a Delhi-based company? 2012 was a good year for JP Associates. Market men were betting on a big turnaround in the cement business. Some were betting of a stake sale in the cement business. The turnaround has not happened, and the stake sale, unfortunately, also has fallen apart.
I think too many bets were placed on the stake sale, and the stock really outperformed a lot of others in the same sector in the last couple of months. I think because things are getting delayed, nothing has happened on that front. Plus, there's a concern as far as the infrastructure or the real estate business is concerned. So I think because of all those delays happening there, and plus the concerns remaining in the other parts of the business, I think people are losing the patience and again selling or booking profits or even taking a short position in the stock. And I also don't have too much a bullish stand on the stock right now, because the stock has been very volatile in the past 2-3 years. I think we need to look at stocks right now with more stability of earnings first. I think once those stocks are reaching peak valuation, we'll look at stocks like JP may be a little more expensive from the current levels, but I think I'll still wait and see how the stock performs.